Good afternoon. My name is Marcus Nolan. I'm the Executive Vice President and Director of Studies here at the Peterson Institute. Excuse me. I'm also co-editor with Dong Hyun Park of the book that we are releasing today, which I stupidly left sitting at the table, From Stress to Growth, Strengthening Asia's Financial Systems in a Post-Crisis World, which we are co-publishing with the Asian Development Bank. One thing that I learned, I learned from Adam Posen, it's actually not from Adam Posen, it's from Adam Posen's wife, Jen Sosin, is that when launching books, you should actually have the book, and you should mention the title 3 times. So I've got one down. All right. Wearing my Executive Vice President hat, on behalf of the Institute, I would like to genuinely and sincerely thank the Asian Development Bank, with whom we have had a very fruitful collaboration of a number of years, and recognize the cooperation of both people based in Manila as well as the Washington office headed by Craig Stephenson. Wearing my co-editor hat, I would like to thank my collaborator, Tom Park, from whom you will hear momentarily, as well as our authors, quite a few of whom are actually present today. In the audience, Jay Chopra, Nicola Verone, and Nick Lardy, all of the Institute, are here. And you will hear in a few minutes formal presentations by Institute Senior Fellow Bill Klein and the Institute's President, Adam Posen. In addition to these people, we are delighted to be joined this afternoon by Professor John Berger of Loyola University, who co-authored one of the chapters in the book, and we'll talk about that a little bit later. I would also like to thank the Publications Department for their efforts in producing the book, and I believe that the contents of the book justify the truly striking cover that the Publications Department created for From Stress to Growth, Strengthening Asia's Financial Systems in a Post-Crisis World. The book addresses the issue of financial sector development in Asia. And insofar as we have a number of the authors here today, and they will be making their own presentations, what I would like to do is give a brief review of the book's contents, highlighting the contributions of the authors who are not making formal presentations. Our basic starting point is the observation that while Asia's real economy has performed robustly over the last half century, the financial sector has lagged. And one might object that the fact that Asia managed to grow despite its backward financial system demonstrates that the secondary importance of finance. However, we would argue that Asia grew despite its financial underdevelopment, not because of it. And with a stronger and better financial system, Asia could have grown even faster than it actually did, or put another way, it could have achieved the same rates of growth, but with lower savings and investment. That is to say, with lower costs in terms of consumption foregone. Moreover, the visible slowdown in economic growth in Asia since the global financial crisis of 2007-2009 makes it imperative for the region to fully exploit all sources of economic growth. Financial sector development that delivers a sounder and more efficient financial sector is one potential engine of such growth. Ironically, the global financial crisis, with its origins in the development of complex instruments, inadequate regulation, lax enforcement, and unethical and in some cases even criminal behavior in major Western financial institutions, has given financial reform in Asia a bad name. So in some sense, we are running uphill trying to convince a skeptical public about the virtues of additional financial reform. The 10 chapters of the book address Asia's high priority task of building a sounder and more efficient financial systems that will help the region sustain growth without sacrificing financial stability. The book is organized into essentially 2 parts. The first 5 chapters focus on the relationship between financial development and economic growth in developing Asia. The second 5 chapters address financial regulatory issues to ensure that financial development delivers growth and not instability. Dong-Hyun Park and Bill Klein are here and will present on their respective chapters. So I will simply say that in essence, they address two related issues. First is the relationship between financial development and growth. The second is the relationship between financial openness, defined as the expansion of an integration of foreign financial systems and growth and stability. These chapters examine the too much finance argument as applied to developing Asia and make some comparisons to other regions, including Latin America. The final paper of this section by my institute colleague Jay Chopra takes a different tack. His chapter addresses the issue of how much structure or how to structure the financial sector to encourage productivity and innovation-led growth in developing Asia. And he starts from the simple observation that productivity increase is a multifaceted phenomenon requiring an interlocking set of policies or reforms. The particulars and priorities will vary depending on specific cases, especially with respect to distance from the technological frontier. So in examining developing Asia, Jay reaches two broad conclusions. The first is that given the amount of savings the region generates is the dearth of mechanisms for long-term finance for infrastructure projects, for example. And in some sense, one can view the creation of the Asian infrastructure bank as a response to this lacuna. He makes specific recommendations for financial development in this particular dimension. And then the second conclusion he reaches is actually a broad set of recommendations or priorities that vary by level of development. For the poorest countries in the region, conventional banking reforms, including the reduction of financial repression to better mobilize and channel savings into its most productive uses, remains at the top of the agenda. For the middle-income countries, capital sector reforms to encourage financial sector deepening and easier access to finance for startups and innovative firms and projects becomes more important. And finally, for countries approaching the technological frontier, public policy interventions, which may include the encouragement of specialized finance, including public sector finance or incentives, may be more relevant. The experiences of more advanced countries in Asia and elsewhere may be salient in this regard. The second part of the volume turns from the finance and growth nexus to the nature of financial sector regulation. Again, Adam Posen and John Berger are here, so I will let them speak for themselves on the issue of financial sector regulation and bond market development, respectively. Two papers in this second section of the book specifically address the role of banks. With regard to bank supervision, Michael Zamorsky and Min-Soo Lee emphasize the role that external policy anchors can play in leveraging domestic reform efforts, emphasizing the Bank of International Settlements' Ball core principles as the touchstone. Their recommendations can be summarized into four broad areas. First, adopt international bank standards and conduct self-assessments to ensure compliance with the BCP involving outside assessors is necessary. Second, ensure that legal powers exist to permit comprehensive assessments, including bank affiliates and unregulated entities, by both domestic authorities, broadly defined, and their foreign counterparts. Third, equip domestic authorities with necessary surveillance methods to implement adequate microprudential and macroprudential risk assessments. And fourth, ensure that domestic authorities are adequately resourced and trained to proactively assess bank strategy and risk-taking beyond simple compliance. And additionally, reminiscence of arguments that Bill Klein makes in his paper require that well-defined crisis management and resolution plans be in place, and that domestic law provides for timely interventions and resolutions of non-viable banks. In the next chapter, my institute colleague Morris Goldstein addresses the role of bank stability from another perspective, asking the question of what developing Asia might usefully learn from the stress test exercises conducted in the United States and European Union. He derives 5 basic lessons. Actually, I think many of you here know Morris. Morris loves to make lists. I think in the chapter he actually derives like 8 or 9 lessons, but I've compressed them to 5. First, stress tests are a useful tool, more flexible than the Ball Accords discussed in the previous chapter. That said, the usefulness, this is point 2, the usefulness of these tests depends importantly on their design and the general failure of stress tests conducted prior to the global financial crisis to provide early warning of bank vulnerability demonstrates that the specifics of the exercise are crucial. Third, when capital shortfalls are identified in the tests, the remedies should be implemented in a growth-consistent way, defining capital adequacy in absolute terms and avoiding increases in capital ratios through cutting back on loans, manipulating risk weights, and fire sales of assets. Fourth, because assessing risk weights is difficult and empirically leverage ratios have done a better job of identifying problem banks, these should be included in stress tests. And 5, because the Basel III capital adequacy targets are inadequate, Asian policymakers, and indeed policymakers globally, should gradually increase the capital adequacy standards in stress tests. The next chapter, written by Nick Borst and Nick Lardy, marks a thematic departure from the previous chapters by focusing on the financial sector of a single, albeit crucial country, China. Certain characteristics of the financial sector, including its large size at early stages of development and its orientation towards corporate rather than household borrowers, distinguish it from those prevalent in other parts of developing Asia, but Borst and Lardy nevertheless derive 3 transferable lessons. First, it's possible to rapidly improve the efficiency of state-owned banks. Bill Klein also notes the prevalence of and concerns about state-owned banks elsewhere in Asia in his chapter. Second, while Chinese gradualism is often held up as preferable to big bang-type reforms, there are risks of moving too slowly. And some of the problems evident in the Chinese financial system today are the result of excessively deliberate and incremental change. The final lesson is, as the authors put it, quote, the difficulty of rooting out implicit guarantees and moral hazard in the financial system dominated by state-owned actors, which is, in fact, a recurring theme throughout this volume. Having examined banking issues in depth, the book concludes with an analysis of bond market developments by John Berger, Francis Warnock, and Veronica Caddick-Warnock. And again, I will let John speak for himself. I would simply conclude that by observing that the risk of edited collections is either that they don't hang together coherently or by adopting some sort of uniform formula to try to force disparate issues into some sort of common framework, something essential about those issues is lost. As the co-editor of From Stress to Growth, Strengthening Asia's Financial Systems in a Post-Crisis World, I actually was struck reading the book cover to cover by how well it did hang together, and I look forward to the presentations of our individual authors. Thank you very much.
Okay, I would also like to thank the Peterson Institute for another fruitful and productive partnership we had with my institution, the Asian Development Bank. But instead of talking about the book, I want to talk today briefly, I think I'm given about 10 minutes, about the bigger research project of which our partnership with Peterson was one part. So this was a much larger project. Of course, our partnership with Peterson was a very important part of that, but it was an integral part of a bigger, larger project, which ultimately resulted in the special theme chapter for our annual flagship report, the Asian Development Outlook, the main report. It came out in late March this year. So let me begin. So there are, broadly speaking, 3 basic reasons why financial sector development is an important issue for Asia at this particular point in time, and that is what motivated us to pursue this research project. I think Mark went over them briefly, but let me just reiterate them. The first is financial sector development is a potentially new and important source of growth, which is especially important now because Asia, like the rest of the world, is facing significantly slower growth or growth deceleration since the global financial crisis. So precisely because our financial system is relatively backward, and precisely because we grew rapidly in the past, despite, not because of, but despite having a relatively backward financial system, what that means is getting our financial system up to par in terms of efficiency and soundness, that can potentially generate additional source of growth at a time when we badly need additional source of growth. So the finance growth angle, in other words, financial sector development as a potentially new engine of growth, that's one angle. Of course, the second angle, okay, let me start with that in the interest of time. So, of course, there's a large literature on this, kicked off by Ross Levine and others, that looks at the econometrically, empirically, looks at the effect of financial sector development on economic growth. And ADB colleagues of mine, Arif and Gemma and myself, we did some additional empirical analysis. We do some relatively minor additions to this. The body of literature, the body of studies is already very large, as I said. So what we do, we update the data, expand the country sample. We distinguish between developed countries and developing countries, and further into various parts of the developing world, right? Of course, we're particularly interested in developing Asia, right? We also add financial openness, as well as the foreign exchange regime, flexible versus fixed, right, to put it very roughly. And also because growth also affects financial sector development, not just the other way around. We use an econometric methodology, GMM, to try to address that endogeneity issue. So here is what we find. By the way, the consensus finding from the large body of studies is that, yes, financial sector development does indeed seem to have a positive, significant effect on economic growth. And our recent analysis, which we did for this particular study, seems to reconfirm that. So it's not an earth-shattering new finding, but it is a reconfirmation of a consensus finding from the body of literature. Some one additional finding is that this kind of positive effect of finance on growth seems to be especially significant and large and visible in Asia, in our part of the world. And again, in line with existing studies, the composition of financial system doesn't matter. Banks are good for growth, but so are bond markets and equity markets, capital markets. And this is more controversial finding, less robust finding in that sense. Financial openness also seems to have a positive impact. Last but not least, foreign exchange regime is not relevant to growth, according to our analysis at least. So just to give you some quantitative idea of the impact of growth, well, take a look at this. If our region's average ratio of liquid liabilities to GDP, which is a widely used index of financial development, from 65% to 75%, that would add almost 0.4 percentage points to our per capita GDP growth. And a couple of more interesting facts about Asia is the following. As you can see, this is a large sample of countries from all over the world, developing countries. The brown dots are Asian countries. So here we have all countries, including Asian countries. Here we just have Asian countries. In any case, what's quite clear is that the link or correlation seems to be stronger between finance on one hand and investment on the other hand, seems to be stronger in Asia than in other parts of the world. But of course, Asian financial systems are still heavily bank-dominated systems, right? So we want to look at what impact banking sector has. So this is a sample of Asian countries and Latin American countries, bank assets to GDP, bank loans to GDP ratio on the horizontal axis in both cases is the investment rate, right? Investment to GDP. And quite clearly, there's a positive relationship between relative bank size and investment on one end, and investment and GDP growth on the other end. So banking sector development does, just eyeballing it, seem to have a positive, significant impact on economic growth. Of course, growth is important, but increasingly, certainly from ADB's point of view, and including ADB Research Department's point of view, what's increasingly important is inequality, right? And more inclusive growth. In other words, growth that benefits the broader population rather than a privileged elite. So the next issue we looked at, and this is a part of the broader study, but not part of the book. But anyway, this is what we looked at empirically. How does financial sector development affect inequality, right, as opposed to growth? And then just conceptually, without having read any paper any economics paper on this, just commonsensically, conceptually, the relationship is quite unclear. In other words, there are strong arguments to be made, both for a positive impact and a negative impact. So financial sector development helps to reduce inequality. Just as an anecdotal example, Bangladesh, Nepal, or some other low-income country, the poor farmer there, gets access to finance. He borrows money and uses that borrowed money to finance his promising and talented children's education, who later on has higher income potential. And that obviously helps to reduce income inequality. So clearly there's a case to be made for financial sector development helping to reduce inequality. But on the other hand, if you think about New York or London, 2007, right, just before global financial crisis erupted, then it's mortgage-backed security, CDOs, all these other complicated, complex financial products, financial innovations, which even regulators had the difficulty controlling or even fully understanding or comprehending. Well, it's probably plausible to argue that kind of financial sector development or innovation, many would put that innovation in quotes, of course, benefits mainly guys working at JP Morgan or Goldman Sachs getting their 500% bonuses. So quite clearly in that scenario, financial sector development makes inequality worse rather than helps to reduce inequality. And you know what? When we did econometric analysis, this is a very simplified illustration. We put in a number of control variables and ran some quite sophisticated econometric analysis. But anyway, this shows the central finding, and which is just in line, consistently with the ambiguous theoretical prediction. This is, in fact, what we actually find. In other words, this is financial sector development. This is measure of inequality. Financial sector development helps to reduce inequality but only up to a certain point, beyond which it helps to make inequality worsen inequality. So the obvious question is, where does this occur, right? And quite surprisingly, perhaps, this occurs in middle-income countries. In the Asian context, countries like Malaysia, Thailand. So we are not talking about France, UK, US. We are not talking about Piketty's capital in the 21st century type of countries here. So what that clearly means is financial sector development in and of itself, right, is not enough to reduce inequality. Instead, of course, what is needed is a financial inclusion, right? In other words, extending financial services to poorer households or to smaller firms, right, rather than just the big, well-established firms. Unfortunately, we could not replicate this exercise. Of course, the obvious econometric solution to resolving it would be, instead of looking at the replacing this financial sector development with measures of financial inclusion, right? Unfortunately, the data was not there, so we were not able to perform more rigorous analysis. Instead, we just, this new database from the World Bank, Financial Inclusion Database, this is a measure of financial inclusion, by the way, loans going to the poorest 40%, and this is Gini coefficient. Quite clearly, financial inclusion, it helps to reduce income inequality. But unfortunately, in the case of Asia, although we do well, we do relatively well relative to other parts of the developing world, in terms of financial sector development, the same cannot be said for financial inclusion, right? We are quite comparable. We are not doing that well. So Asian governments need to do much, much more to promote financial inclusion. And finally, so that's the second biggest strategic challenge, right? In other words, helping to broaden access to finance, making ample and inexpensive or reasonably priced credit available to poorer households as well as to smaller firms. That's number two. And number three, because when there's financial sector development, quite often that entails significant risks to financial stability, especially if financial sector development is, as is often the case, coupled with opening up the financial sector to foreign capital inflows, right? So the challenge facing Asia is, even as we develop our financial sector, we have to do it in a way that does not jeopardize, right, or compromise or pose a significant risk to our financial stability. I think that's why, of course, that's probably why China, right, Chinese policymakers are going very gradually with their financial liberalization, which, by the way, but as was said by, as was found by researchers at Peterson, like Nicholas Lardy and others, that also carries, of course, risks of its own. So if you look at it, financial sector instability, especially if it leads to financial crisis, that's bad for growth, and that's also bad for inequality. Look, this is an Asian financial crisis. All these high-flying Asian economies, East Asian economies to be precise, Korea, Malaysia, and others, this is before the crisis, and then all the economies contracted, right? Indonesia, almost 14%. And look at here, and it's also bad for inequality. Look at this is Europe, right? The countries that were hit the hardest, Greece and others. Unemployment rate, right, shot up. When unemployment rate increases, of course, the hardest hit are the poor. They don't have any savings to fall on, right? Fall back on, unlike the rich. And Asia, the problem right now is that Asia remains quite vulnerable to global financial shocks, in particular unexpected and sudden monetary shifts emanating from rich, advanced countries like the US. This is what happened to exchange rate depreciation that many Asian countries suffered during the taper tantrums when Ben Bernanke merely hinted, right, at the QE tapering. Of course, bank regulation is the first line of defense, but I think it's equally important to explore new policy tools to safeguard financial stability. And one of my colleagues at ADB, he did some empirical work on effectiveness of macroprudential tools, right? Macroprudential policies in maintaining or safeguarding financial stability. And his evidence quite strongly indicates that, yes, so far, macroprudential policy has been quite effective as a tool for maintaining financial stability or equivalently reducing financial instability. So, yeah, that's it. Okay. Thank you.
My chapter for this study found that Asian emerging market economies have financial sectors now that are relatively unlikely to provoke new financial crises, either because of reforms after the late 1990s crises in the East Asian area or because of dominance of state ownership, which reduces the likelihood of bank runs. My chapter begins with a brief review of theory. Capital accumulation is the key to growth. Hera, Domar, Lewis, Solo. And the role of financial sector is to mobilize saving for investment and to channel it to the most productive activities, Schumpeter. McKinnon warned about financial repression. Minsky and Kindleberger emphasized the boom-bust syndrome. In the late 1990s crisis, the public cost of financial restructuring reached 60% of GDP in Indonesia, 45% in Thailand, 30% in Korea. So I invoke what I call a Hippocratic theory of finance, which is that the sector should first do no harm. In the empirical literature, the classic cross-country study by King and Levine in 1993 found that going from the first quartile to the fourth quartile of financial depth boosted growth by 0.4% per year. Most of the literature finds this positive relationship. After the Great Recession, however, there's been a revisionist literature which has argued that too much finance spoils growth. In the book, I'm skeptical about that literature And since that time, I've published 2 working papers critiquing it. On page 82, you'll see a fuller version of this evidence on growth. Asian emerging market economies led world growth in 2000 to 2013. I like to use the excess of the growth rate over the growth rate of the working age population as my best single indicator of performance. And this was 9% in China, 5% in India, 3 to 4% elsewhere in Asia, compared to 2 to 3% in Latin America, except for high performer Peru. There were correspondingly high investment rates, as you can see in other columns. The close link to investment, of growth to investment, supports the proposition that capital is crucial to growth. In this chart, you can see that the Asian economies grew faster than those in Latin America because of higher investment. Now, efficiency is also important. The observations above the trend line show greater efficiency because of a lower incremental capital output ratio. And Philippines, Peru, India, China all have an I-core of about 4. In contrast, those below the line have lower efficiency, with Mexico having an I-core of 10. Now, it turns out that for the banking sector, several of the countries are quite developed. Bank assets exceed 200% of GDP in China, Korea, Malaysia, and Thailand. This is on page 88. Now, the banks also are fairly concentrated. And when you combine the influence of concentration with the influence of the depth, the financial depth, the average top 5 bank has assets of 30% of GDP in Malaysia, 20% in Korea and Thailand. And that's well above the 11% in the United States, where it's already a concern. So too big to fail issues might make it attractive to think through resolution arrangements in these economies. Regarding measures of health, the credit default swap spreads are moderate, somewhat higher in India, Brazil, because of sovereign risk. Now, the ratio of bank capital to assets is somewhat lower in China and India than in the other Asian economies and Latin America. However, the high role of the state sector in the Chinese banks, at 90%, and in India at 74%, might make it less urgent to have high capital ratios. State ownership is also high in Sri Lanka and Vietnam. Now, in contrast, foreign ownership of banks is remarkably high in Korea and Mexico. And both countries use the strategy of inviting foreign banks in to help stabilize their financial sectors after their financial crises. In broader terms, financial intermediation has also shown rising domestic bond and equity markets. Finance to the, this is on page 93 of the book, finance to the non-government sector, including bank and non-bank loans, domestic bonds, and market capitalization of equity, was an average of 190% of GDP in emerging Asia, 115% in Latin America in 2013. So it's not low. It's not as high as the 300 to 400% that you get in Japan and the United States, but it's substantial. Now, intermediation is below 100% of GDP in only 2 of the main Asian emerging market economies, Indonesia and Sri Lanka. But it exceeds 250% in 4, Korea, Malaysia, Thailand, China. And that's even before last year's surge in the Chinese stock market. Malaysia has exceptionally high equity, 160% of GDP. It's also high in Philippines and Thailand. Table also shows a strong presence of bond and non-bond finance, but the overall implication is that the level of financial intermediation is already relatively high, so that suggests that the most important thing going forward is more attention to the quality and robustness of the sectors rather than sheer size. On external finance, in my chapter, I recapitulate my 2010 results of a meta-statistical analysis of the influence of openness, financial openness, which came up with the conclusion that a conservative estimate is that going from complete closure to complete openness contributes 0.5% annual growth in cross-country experience. Now, my paper shows that in the Asian area, there's been some backsliding in financial openness since the Great Recession in Thailand, Malaysia, and the Philippines. Now, of course, financial markets have remained relatively closed right along in the important cases of China and India. The chapter reviews the fund's financial sector assessment and Article 4 reports, and basically finds that the fund gives a relatively sound bill of health to the financial sector in Malaysia, Korea, Philippines, Thailand, and Indonesia. And I conclude that it's not a coincidence that all of these countries were involved in the East Asian crisis in the late 1990s. They undertook reforms and are stronger for it. In China and India, the heavy ownership of the banking sector by the state limits the risk of confidence crises and provides a certain stability in that sense. Questions, of course, are about efficiency of the state bank loans, and questions such as overextended housing sector and unregulated wealth management products in China. And the fund's reviews also showed sobering critiques of the lack of legal protection of bank regulators in Indonesia, Philippines, and Vietnam. My policy conclusions are, first, that there should be conscious plans to decide whether to keep very large state ownership of banks or to slim them down consciously. And if in the former case, conscious plans to ensure efficiency of the state-owned banking sectors. Interest rate controls should be eliminated. Domestic bond and equity markets should be developed further, especially in Indonesia and Philippines, where they lag, including through the improvement of shareholder and creditor rights. There should be regulation of shadow banking, and it is important to get the macro policies right, especially fiscal sustainability. Thank you.
Mark just told me I have 2 minutes. Hi, I'm John Berger from Loyola University, Maryland, and I'm presenting work that was jointly done with Frank and Veronica Warnock of the Darden School. Our chapter describes and analyzes the extent of bond market development with a particular focus on local currency bonds. We are motivated primarily by some of the lessons from the Asian financial crisis of the late 1990s, when it was revealed quite abruptly that there are financial fragilities associated with a currency mismatch. In fact, there was a Peterson book on that topic about 10 years ago, authored by Morris Goldstein and Philip Turner. So that's our second shout out to Morris today, right? I don't have his list from the book, but that book was part of a greater debate over the original sin hypothesis. Frank and I also had some papers in that area. And the original sin hypothesis took a relatively pessimistic view of the ability of emerging economies to develop local currency bond markets. The hypothesis basically suggested that emerging economies had an innate condition that inhibited the ability to borrow in local currency. However, when you turn to the data, over the past 10 to 15 years, there's been remarkable progress in the development of these bond markets. So here we see that in Asia in particular, there has been remarkable growth in the size of local currency bond markets. Here we're scaling local currency bond markets by GDP. Now, certainly, if we were to compare this to advanced economies, we would say these bond markets are still quite small. However, there's been considerable growth, particularly in Asia. Another way to evaluate the data would be to look at the share of all bonds denominated in local currency. Here again, Asia leads the pack with roughly 95% of bonds in Asia denominated in local currency. Now, I should note that that data is dominated by some of the largest economies, and there is heterogeneity among, across countries in the region. Also, it's striking looking at that graph to see the progress made in Latin America. If you go back to 2001, roughly 50% of bonds outstanding in Latin America were foreign currency denominated. That ratio has moved to the point where 70 to 75% are now local currency denominated. Here we split out the government issue from private issue. The green bars are government-issued bonds, and they're certainly the largest fraction of emerging market bonds. This is all emerging economies lumped together now. But perhaps less well-known is that the blue bars are private-issued local currency bonds, and that's the fastest-growing component. Considerable growth over this period of 2006 to 2011, which is where our data ends. So we look at that data and say, it's hard to support the pessimism of the original sin hypothesis. There has been considerable progress in growing these local currency bond markets, and there have been a number of studies looking at the determinants of bond market development. What enables one country to borrow in local currency versus another? And here's just a couple of simple pictures that show that the countries that are struggling to borrow in local currency tend to be the ones with high and volatile inflation rates and with less protection for creditor rights. We conclude, therefore, that the factors inhibiting the development of local currency bonds are not original, just sin. In our chapter, we dive a little deeper into some of the Asian economies. Here's just an example. Looking at the green line in particular here would be the share in foreign currency, and the Philippines and Vietnam are kind of more recent developers of local currency bond markets. The Philippines still has 30% foreign currency denominated, but that's progress relative to, say, 50% in 2003. So that green line is coming down, meaning more local currency, less foreign currency. Vietnam, go back 10 years or so, essentially had no bond market. They are rapidly developing a local currency bond market. However, we should caution that the currency is just one factor to consider. We should look at maturities as well. And here we get a different story with this particular case study. The blue line tells us that in the Philippines, the share of local currency bonds that have a maturity of 10 years or greater has increased. So the Philippines have demonstrated an ability to borrow in local currency long term. Whereas Vietnam, although they are issuing local currency bonds, they're pretty much all shorter term bonds. They have not yet developed the ability to issue a long term local currency bond. Finally, we must emphasize that most of the data analysis is on the larger of the emerging economies in Asia. If you look at the whole group of what ADB classifies as emerging Asia, 42 countries, the median size of the bond market is still 0. So there's still, the vast majority of these economies don't have a bond market yet. Now, what is inhibiting bond market development more broadly? Go back to the factors in the literature, and we find, for example, that countries that have not yet developed a bond market have twice the inflation rate of the countries that do have bond markets, suggesting, therefore, that there is a role for creditor-friendly policies and institutions in enabling bond market development more broadly in Asia. Thank you.
Good afternoon. Thank you all for joining us today. I need to reiterate what my colleague Marcus Nolan said, that we are very proud and pleased of our rewarding ongoing partnership with the Asian Development Bank. Marcus for us and Dong-Young for ADB Research have been the leads in this effort, and this year's book, From Stress to Growth, remains, I think, a vital and exciting example of what we can do together. And of course, as Dong-Young said, we had the privilege to have input, obviously that they could take or leave, but input into the development of the ADO and the bank's financial agenda, and we're very glad to have had that constructive engagement. Even last year, we published a book titled, I should be holding that up too, Responding to Financial Crisis, Lessons from Asia Then, U.S. and EU Now, again, joint, and had some very important, challenging papers, including from Simon Johnson and Ted Truman, about the substantive hypocrisy of U.S. and other Western positions that I say substantive hypocrisy because it wasn't merely hypocrisy. It was the things that they told Asia to do during the financial crisis in the 90s, they then didn't do themselves when they had their own financial crises. But importantly, it was substantive in the sense that the advice they had given Asia back in the late 90s was largely right, and they should have listened to their own advice then, and we did not. And we're proud of that book, and I think we're even more proud of this year's book. As Mark said, it really does hold together, and there are two pieces to the argument. The question of if Asia grew, particularly developing, fast-moving Asia grew despite financial backwardness, and then, as partly indicated in just the most recent presentation, developing Asia didn't grow because of lack of financial support. We need to make the case for finance in Asia, and that is obviously a controversial thing to do in a world where there has been this long-standing belief that Asia had a safer, bank-centered, more conservative, higher savings model, not with bond markets, not with turbocharged Anglo-Saxon finance. But then also there's the question, as Dong-Young, I think, made very clear, how do you make that work? And one piece which the bank is leading on is the issue of financial inclusion, but the other piece, as we've talked about, and at least 3 of the 5 contributions we made to the volume are about the financial stability aspect, that if you do try to develop the financial markets, and this is presumably helpful to growth, how do you ensure might be too strong, but how do you increase financial stability? How do you minimize the risks to financial stability in that context? And so this paper, which is a genuine joint effort, although Nicola might deservedly claim more than half the credit, is co-authored with Nicolas Véron, fellow here. And our role was to say, take the financial development as a necessary and good idea, but then what are the regulatory and particularly what would be considered the long-term institutional and macroprudential things you can do to make financial stability more viable when you are developing the financial market. And we have come up with, we would argue, 4 practical steps. And I think, or guidelines, let's say. And this is obviously going to be different. The ADB in developing Asia is a very wide place. It is different for Kazakhstan than it would be for Vietnam, than it would be for New Guinea, than it would be for other places. But we think there are broad principles we can agree on, and I think the most important starting point is we challenge the idea that there's this basic trade-off between financial repression and instability. So sometimes among Asian policymakers, in fact among many critics in general, there is a sense that, well, If we give up the go, go, go of the Americans and the Brits and the other Westerners, then we will not have the instability. Or you hear even stronger versions of that, that if we really continue the kind of financial repression that we knew was part of the history in Japan, in Korea, that actually is good for stability, and the cost of growth is not much. And our contention is not just on the cost of growth, which is dealt with by the other authors, but that repression is not a means of preventing instability. Various forms of financial repression, badly managed, actually create instability. And this is where Nicolas Véron's important work on the European crisis and the development of banking union in Europe plays a role. We also, in recent months, published a short study by Monica de Bola on the disruptive role of BNDES and other state banks in Brazil. Again, our point is not to say that you need to go to the full-on Anglo-Saxon, Anglo-American turbo finance model, but to say that you do not make your people safe, you do not make your economy safe simply by repressing what you have. And this, of course, is also in dialogue with the chapter by Nick Lardy and Nick Borst on China. And so the four general guidelines we give is first that you want to diversify your domestic financial system as feasible. Now, as feasible is a key point. Again, if you're a tiny island nation, that's may not be entirely possible. But we mean diversity in two dimensions. First, that there should not be a few or one or two single large actors that dominate the system. But secondly, and going with the spirit of John Berger and co-authors chapter, that it should not be solely a bank-dominated system. And this isn't so much because banks are a problem, but so much more that non-diversified systems are less resilient over time, as well as not having good options. Second, to the degree you're going to do repression, and to make a joke I make regularly, one person's repression is another person's prudential regulation. To the degree you're going to do constructive repression of certain financial activities, you want to concentrate on that word, activities. It's not about bottling up savings, as was sort of the caricature received wisdom of the East Asian miracle, that you give your savers no returns and everything works out okay. Third, that in the context of a developing Asia that is networked, and which is obviously all the more important given China's development at present, there is room for regional financial centers to play a role and cross-border lending. And again, this relates back to the mismatch issue that was discussed previously. There is a role for a Shanghai, a Singapore, a Hong Kong, a Tokyo to be there. Not every country has to have its own national champion. However, there are cautions that go with this. And fourth, and this is probably the point where Nicola and I are a little less in complete union, but I think we are largely there, that there is a role for what now are called macroprudential tools. These can be used in a positive way. They are particularly useful with regard to real estate booms and busts. That is a key role. That is obviously not the only thing that's a macroprudential problem, but it is important. So, again, not to go on too long, there is this tendency from the global crisis the last few years to say, well, you know, the Asians may have had it right, and broadly speaking, and the Anglos and Europeans may not. And I think there has been a legitimate deep focus on the dangers of excessive or unrestricted financial innovation with a focus in the US. Again, Bill Klein and I might disagree on this point, but I think there's been a lot of things in the derivatives market, in the so-called shadow banking, that were not necessarily terribly constructive. And so we've ended up with a consensus that's out there, at least for the advanced economies, that the US, at least compared to Europe, had more rapid financial restructuring, that doing so with things like TARP and aggressively dealing with bad and distressed assets actually can yield a profit and works. Self-financing is much more important than yielding a profit. And this is a contrast with Europe having these bank-dominated systems that have been persistently fragile for some time. So I do think we still need to go a little deeper and get beyond the simple trade-off. It is legitimate for us to conclude that avoiding financial crisis is so important, you have to be willing to pay some upfront cost. It is like other insurance. However, and we would furthermore agree that excessive liberalization increases both the risk and the cost of financial crisis. But we would push back against some lazy thinking in Asia, and I think the ADB would agree with us on this, that you cannot from that conclude that bank-centered systems are inherently more stable. In fact, we would argue Europe shows the opposite, that financial repression is always stabilizing, that every form of offshore intermediation is a danger, and that what the FSB and others have done so far in terms of microprudential supervision is sufficient. So let me put quickly some meat on our recommendations. Diversified domestic financial systems. So this is partly based on some work I've been doing, supported by a major grant from the Sloan Foundation, for which I'm grateful. Resilience, we find, comes through a diversity of institutions in a financial system. The mental exercise is, if you look at how the US and Germany bounced back from the crisis versus, say, the UK and Spain. And in the US and Germany, you had much more diversity of financial institutions. In Germany, it was predominantly banks, but there was many varieties of banks, many regions of banks, many small banks, community banks, many avenues. In the US, of course, we had many avenues of finance, commercial paper, junk bond markets, venture capital, non-bank issuers of all kinds. And therefore, even when, if our banks, so to speak, if it was Commerzbank in Germany or Bank of America in the US or whoever, messed up just as badly as RBS in the UK or the Caixas in Spain, the resiliency of the economy, the ability to keep financial flows going, particularly to investment, was much higher in those countries with diversified financial systems than a Spain or a UK, where there were only a few big entities who ran the show. And so for developing economies, it is therefore reasonable to think about not trying to create your own national champion, not trying to create your own BNP Paribas, your own city, but continue to develop local banks. And from those more advanced, picking up on where John and his co-authors were, to promote local currency bond markets, both corporate and government. And then for the financial sectors in the region, to think about vanilla securitization, again, vanilla CP, not doing massive financial innovation, but diversifying the forms of finance available. Now, there will remain, and from the starting point most of these countries are in, including arguably China, Korea, Japan, which we should no longer call developing, obviously, there is a way to come from where you are bottling up savings and financial repression, to use Carmen Reinhart and many other people's term. And as I said, good financial repression is simply good prudential regulation. And so you can think about things like sharp controls on prop trading. You can think about things where the institutions that have the bulk of saving do invest primarily in good capital in bonds. But you do not want to simply view this as a chance to compress interest rates and get subsidized loans to the rest of the economy. That actually foments and promotes financial instability. It would be destabilizing. And in our paper, in our chapter, Nicola and I go through some examples of how in Italy, for example, despite huge financial depression, both de jure and de facto, they managed to have a very unstable financial system. Cross-border financial integration, we don't give the issue quite as much depth as it deserves. Perhaps in next year's project with the bank, we can hope to tackle such issues. But it's clear, just as we were saying earlier, as Dong-Young was saying, about pure size of finance, again, it's more nuanced. There's an ambiguous impact on financial stability to have cross-border flows. But we saw, for example, in Eastern Europe, that there were circumstances where, with proper management, various parts of Eastern Europe, or rather what's now called Central Europe, EU membership Europe, that the flows were maintained because you had flows from Sweden and Austria, and you were not solely dependent on the capital and the panic of a Czech Republic, of a Poland, of a Hungary. At the same time, obviously, there are mismatch issues, as Morris and many others have written about. We also have, and Nicola has written about this in other contexts, the issue of the assessment bias of national authorities. The tendency, of course, is you go soft on your own banks even if you want to regulate the hell out of everybody else's. And so there is some virtue sometimes to having cross-border banks that attract greater scrutiny. So we think there is room to think about regional centers doing cross-border lending and maintaining a relatively stable flow. I think it is important also to understand that the national origin of lenders is not as critical as people make it out to be. as in a very seminal paper, I think now 15 years ago or more, my old colleague from the New York Fed, Linda Goldberg, argued in the Mexican crisis and many other crises, it was the local banks who got out first. It was the international banks who didn't know quite what was going on. This is a repeated pattern. So you want to have a good blend. I mean, currency mismatches are a risk, but let us not be totally blind to this. Shortages of credit in growing economies are a risk too. So you have to get the trade-off right. I think, sorry, I'm going to skip over, I'm going to skip over information technology because I know nothing about it. That's not true. I know a little, but I'm not going to waste your time with that. Finally, on macroprudential tools, I think there is a role for aggressive use of macroprudential tool, and in a sense, Asia has been the world's, East Asia in particular, has been the world's laboratory on this. We have seen various countries, South Korea, Singapore, Hong Kong's not a country, various places in Asia, now China, undertaking quite aggressive macroprudential measures. And again, it's one of those glass half full, half empty questions. People will say, well, they've thrown everything at it, and it doesn't seem to work. My personal interpretation of data, which I think Nicholas will partly agree with, is that they've thrown everything at it, and it does seem to work, but you have to throw a lot. And so very aggressive interventions, you need to think both in terms of supply and demand side tools for credit. There is emerging evidence since we wrote the paper coming out that demand side tools seem to actually be more effective than supply side. That's something to think about going forward. It is easier. This is one place where being a late adopter or less developed economy is easier. You can exert more macroprudential control if you're a less financially developed economy. And so the less developed economies, as long as it's temporary, targeted, and all those lovely words, should be ready to use that. And importantly, it is real estate booms and busts that are most susceptible, at least in our current state of knowledge, to macroprudential tools. And that arguably at earlier stages of development is going to be one of your biggest sources of financial instability. In fact, you could argue that is true all the way up the development scale. But at a minimum, in non-diversified economies, it's okay to concentrate on that. So to conclude, we view the promise of growth and financial development, the linkage between them in Asia that Dong-Yong and Bill and our other co-authors in this book spoke about, to be real. We view, however, the need for a proper calibration, a proper thinking of what degree of development, what kinds of innovation, and how far to go in unleashing repression. And we think the biggest things you can do are to increase the diversity of the financial system, no matter along both the question of how many players you have and the types of players from more advanced economies, that you have to be pragmatic and emphasize the more dangerous activities and less so the bottling up of savings for your regressive activities, that financial infrastructure is indeed important, and that's why some cross-border lending and investment from outside financial firms can make a difference. And that finally, the international system, as we all know, has not done a great job at the FSB level of taking into account the needs of developing countries, which is of course understandable since it's driven by its de facto mandate to try to make sure it doesn't happen again in the money center economies. But it is reasonable to have an Asian perspective on this and policies targeted towards Asia, and for that I commend Dong-Yong and Marcus for taking us in that direction. Thank you.
Okay, so we have a few minutes for question and answer. We have a microphone in the center of the room. I would have thought that we would have a roving microphone as well. We do. Here's what I would like you to do. Let's collect the questions. Given our limited time, let's collect the questions, and please address your question to a specific member of the panel. Everyone doesn't have to address every question. So with that, who would like to start? Nick Lardy.
Nick Lardy, Peterson Institute. Question for Adam. What is the Hong Kong experience with macroprudential regulation with respect to housing? Tell us. it seems like the conventional wisdom is that they have a bubble of enormous size despite throwing everything at it.
My interpretation, and obviously there are studies both done and to be done on this, but my interpretation is they had and have, until very recently, arguably the strongest predetermination to have a housing bubble of any place pretty much on Earth. It is a tiny place, offshore in all senses, to the Chinese market. It is a place that is a huge refuge for capital and for individuals. It is a place that, like Manhattan and certain other places, has very fundamental constraints on land and space. And it is a place that, for reasons of its peg and its culture, has enormous capital inflows, openness to capital inflows, excuse me. And so the issue isn't so much did they or did they not have a bubble. Of course they did. This was an inevitable first form of diversification, as you've written about, of Chinese savings out of China for anybody who could. However, the question is how much destruction did this wreak on the economy in terms of disruption of ongoing investment, disruption of local consumption, not just were interest rates high or low, were housing prices high or low, which matter, but was there truly instability in the economy and breakdowns in the credit system and major non-performing loans and losses accumulated? And the answer on all of those is Hong Kong's actually done surprisingly well, especially considering for its proclivity to have capital inflows. And so to me, I push back at that received wisdom. I agree with you, that is the sense. And I think it's unfair because they were essentially the most challenged place you could think of to maintain financial stability in the face of the flows they had. And they actually may not have had real estate asset price stability, but in the sense policymakers should concern themselves about, they've had pretty good financial stability.
Any other questions? If there's no questions now, I will ask one question, which may well be the last one. My question is directed to my co-editor, Dong-Hyun Park, and it regards an issue that he touched upon in his presentation, which is how vulnerable do you think Korea is to the anticipated increase in interest rates at the next Fed Open Market Committee meeting?
Well, I don't think Korea is particularly vulnerable because we have quite strong fundamentals, and even during the taper tantrums of May, June 2013, we were one of the least affected countries precisely for that reason. And by all accounts, emerging markets in general are likely to be much less vulnerable than during May, June 2013. So in short, I expect for all of those reasons, strong fundamentals, the financial markets have had time to incorporate this expected shock from the Fed, the shock being an interest rate increase or monetary policy normalization. So for all of these reasons, that impact is likely to be very limited.
Are there any other questions? If not, I would like to close this session by thanking the Asian Development Bank for their cooperation in producing this co-published book. I would like to thank my co-editor, Dong-Hyun Park, for his work on this project. I would like to thank our authors. And before I thank all of you for coming out on this rainy afternoon, I would like to remind you that the holiday season is coming up, and From Stress to Growth would make an excellent stocking stuffer, especially for the more quirky members of your family. So with that, I will call this meeting adjourned. Thank you.